Good morning, ladies and gentlemen, and welcome to Kimco's fourth quarter earnings conference call. Please be aware today's conference is being recorded. As a reminder, all lines are muted to prevent background noise. After the speaker's remarks, there will be a formal question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. At this time, it is my pleasure to introduce your speaker today, Dave Bujnicki. Please proceed, Mr. Bujnicki.
Thanks, Cynthia. Thank you all for joining Kimco's fourth quarter 2011 earnings call. With me on the call this morning is Milton Cooper, Executive Chairman, Dave Henry, President and Chief Executive Officer, Mike Pappagallo, Chief Operating Officer, Glenn Cohen, Chief Financial Officer, as well as other key executives who will be available to address questions at the conclusion of our prepared remarks. As a reminder, statements made during the course of this call represent the company and management's hopes, intentions, beliefs, expectations, or projections of the future, which are forward-looking statements. It is important to note that the company's actual results could differ materially from those projected in such forward-looking statements. Information concerning factors that could cause actual results to differ materially from those forward-looking statements is contained in the company's SEC filings. During this presentation, management may make reference to certain non-GAAP financial measures that we believe help investors to better understand Kimco's operating results. Examples include, but are not limited to, funds from operations and net operating income. Reconciliations of these non-GAAP financial measures are available on our website. Finally, during the Q&A portion of the call, we request that you respect the limit of one question so that all of our callers have the opportunity to speak with management. Feel free to return to the queue if you have additional questions. With that, I'll now turn the call over to Dave Henry.
Good morning. Thanks for calling in today. I'm a little under the weather, so I'm going to ask Scott Onifray to read my prepared remarks, but I will be available for any easy questions after this.
We are very pleased with our fourth quarter and full year results, and we believe they represent continued solid and steady progress on our key goals and objectives. Our earnings release contains the detailed numbers for the quarter, but I would like to highlight certain areas and provide further updated information on others. Overall, and step by step, our retail portfolio continues to strengthen as evidenced by the key metrics, or as we like to say, our vital signs. 7 straight quarters of positive same-store NOI growth, positive leasing spreads of 4.9%, and a 30 basis point increase in our occupancy altogether present a strong and improving picture. The economy and our retailers are both showing tentative signs of shrugging off the anemic recovery and focusing on growth. With virtually no new development in our retail sector, sustained population growth, and improving GDP numbers, we are beginning to see an increase in effective rents, particularly in our strong core markets such as Long Island, South Florida, Baltimore, Washington, Puerto Rico, and Canada. We also continue to make good progress in reducing our non-retail portfolio. From $1.2 billion in early 2009, we now stand at $495 million, representing less than 4.5% of our total assets. Our largest remaining single investment, the In-Town Suites portfolio, is attracting increasing levels of interest as we have now broadened the marketing efforts with our partners' permission and as hotel properties are again being aggressively pursued by investors. There are several parties which have conducted extensive due diligence, and we are confident that we will be able to sell the portfolio in the near term. At the property level, In-Town continues to perform very well, with RevPAR increasing substantially. We also have a significant number of other non-retail properties under contract, which will further reduce the amount of the remaining non-retail portfolio. Under Mike Pappagallo's leadership, we are also making strong progress on our recycling initiatives. In 2011, we sold 31 non-strategic retail properties, while at the same time we bought 17 high-quality shopping centers, virtually all in our core markets. We are committed to continuing to sell our non-strategic shopping centers, which will upgrade our portfolio and permit us to concentrate on superior properties in our core markets. Internationally, our Canadian portfolio is maintaining its very high occupancies and benefiting from strong retailer expansion highlighted by Target's commitment to open 25 stores in Canada each quarter beginning in March 2013. The Canadian economy remains strong with 2% GDP growth forecast for 2012, continued low interest rates, and moderate unemployment levels. We are pleased that we are able to buy a high-quality grocery-anchored center in December in the Greater Vancouver market, and we hope to close on another attractive grocery-anchored center in Edmonton shortly. In Mexico, our retail portfolio is making leasing progress, hitting 84% combined occupancy in the fourth quarter, including several new developments. The Mexico economy is strong with 3.9% GDP growth in 2011, higher than that of Brazil for the first time in 8 years, a strengthening currency, and strong retail sales performance. Overall, Mexico's same-store retail sales increased 8% in the fourth quarter and 5% for the full year. We are seeing increased leasing demand from national and international anchors and sub-anchors. Interestingly, anchor retailers in our Mexico portfolio paid percentage rents exceeding $2 million in 2011. And as I like to remind everyone, all of our leases in Mexico contain full annual cost of living escalators. As we move forward into 2012, we feel very pleased with our results, and we believe 2012 will be another year of increasing FFO, portfolio improvements, and success in recycling capital to create a very high-quality retail portfolio in our core markets, where we have scale, terrific demographics, and strong retailer relationships. On this call, I would also like to acknowledge and formally thank Barbara Pooley for her hard work and contributions during her 5 years with the company. Her departure was on good terms as reflected in the mutual and amicable separation document filed with the 8K. Barbara remains available to the company for advisory services and consultation for an extended period. Now I would like to turn to Glenn to discuss the financial details of our fourth quarter, to be followed by Mike and Milton.
Thanks, Scott. Dave, we hope you feel better quickly. Our fourth quarter results demonstrate a continuation of the strategy we set forth at our Investor Day almost 18 months ago. The strategy that is focused on our property operating metrics, which Dave has coined our vital signs, such as occupancy, same-site NOI growth, and leasing spreads. The continued monetization of non-retail assets and the disposition of non-strategic retail assets, while using the proceeds for acquisitions of shopping center properties in the key markets we have identified. All these activities are being executed with an eye toward a strengthening balance sheet, strong liquidity position, and improved debt metrics. I'm pleased to report we have been executing on all aspects of the strategy. Let me expand upon the results noted in the earnings release. Headline FFO per share came in at 33 cents for the quarter, bringing headline FFO to $1.27 for the full year, as compared to $1.21 for 2010, a 5% increase. The fourth quarter 2011 headline amount includes 4 cents of transaction income and a penny of impairment charges. The results I just mentioned have been adjusted to reflect the NAREIT revision to the FFO definition, which now excludes impairments of depreciable operating assets and depreciable assets impaired in joint ventures. We have adopted the revised definition and have adjusted previous periods to reflect the modification. Our recurring FFO per share for the fourth quarter was 30 cents, with a full-year recurring FFO per share result of $1.20, compared to $1.14 for 2010, a 5.3% increase. This meets the top end of our guidance range. The recurring FFO increase is attributable to a 5.7% increase in recurring retail contribution, fueled by positive results at the operating property level. The revised NAREIT FFO definition has no impact on recurring FFO and FFO per share. Our shopping center metrics continue to improve. Gross occupancy for the U.S. portfolio increased 30 basis points from last quarter and is up 50 basis points from a year ago to 93.2%. Gross occupancy on a combined basis, including the U.S., Canada, and Latin America, increased 30 basis points to 93.3%. Same-site NOI growth was 1.6% on a combined basis, representing the 7th consecutive quarter with positive results. Our same-site NOI was negatively impacted by about 20 basis points due to the weaker Canadian dollar and weaker Mexican peso. We also had positive leasing spreads this quarter of 4.9% combined from new leases, renewals, and options. Our momentum toward our non-retail monetization objectives continue with the sale of $7 million of illiquid bonds, the return of our preferred equity capital, plus a $9.6 million promote on one of our preferred equity investments, the sale of several urban assets, and our Canadian hotel portfolio. In addition, since year-end, we have monetized several other non-retail assets, bringing the balance to $495 million, or a reduction of over $300 million since the beginning of 2011, exceeding our annual target. During the quarter, we sold 5 non-strategic retail assets from the consolidated portfolio and 2 others from joint venture programs for a total proceeds of $55 million. For the year, we disposed of 31 non-strategic retail assets. Proceeds from the non-retail and non-strategic asset sales were quickly put to work with the acquisition of 10 wholly owned assets for an aggregate purchase price of $204 million. Our balance sheet and liquidity position is in excellent shape. Our net debt to recurring EBITDA was at 6.2 times. If you pro forma in the EBITDA from the late fourth quarter acquisitions, the metric stands at 6.1 times. We remain committed to a net debt to recurring EBITDA level of 6 times by the end of this year. As a result of the transaction income during the quarter, the headline net debt to EBITDA was 5.5 times. We have in excess of $1.4 billion of immediate liquidity through our recently renewed revolving credit facility. Our consolidated debt maturities are well staggered, with only $350 million of maturing debt this year, mostly in the latter half of the year. The bank market and public capital markets are open, with noticeable spread tightening for unsecured bonds and perpetual preferred issuances. This may present an opportunity later in the year for us when our 7.75% perpetual preferred issuance becomes callable in October. We will continue to monitor closely the capital markets. Lastly, I'd like to provide additional color around guidance. As a result of our completed property-by-property detailed budget process, we are reaffirming 2012 recurring FFO per share guidance of $1.22 to $1.26. This guidance is based solely on recurring flows and does not assume transaction income or impairment charges, if any. Assumptions used in determining this guidance range include an increase in combined portfolio occupancy of 50 to 100 basis points by the end of 2012, and combined positive same-site NOI growth of 1.5% to 3.5%, providing a midpoint increase of 4% from recurring retail flows. We anticipate a decrease in the non-retail contribution as a result of the continued monetization of these assets, including the in-town suites portfolio, and a continuation of the capital recycling plan. As a result, our capital plan assumes no new equity requirements. These assumptions support our dividend level of 19 cents per quarter. And now I'll turn it over to Mike for his report on the shopping center portfolio.
Thanks, Glenn. On the operating side, we are pleased with the solid finish to 2011 in terms of the portfolio metrics of occupancy, leasing spreads, internal growth, and the investment and disposition activity as reported to you last night. Leased occupancy improved across the board, both anchor spaces and small shops, as well as overall in our strategic portfolio. The 70 basis point increase in the overall U.S. occupancy rate over the past year was driven by both positive absorption as well as the effect of dispositions of the bottom tier of the portfolio. Another encouraging sign is the continuing deceleration of vacancies of smaller box users coming out of the holiday season. Vacates of space under 10,000 square feet for the first quarter were at their highest in the first quarter 2009 with 645,000 square feet, then dropped to 557,000 square feet in 2010 and 361,000 square feet last year. Through January of 2012, we're trending even better than that, providing a bit of positive news in the health of this component of our tenant mix. And as a fun fact, I would offer that not only is our portfolio getting healthy, but so too are the consumers visiting our centers. Loss of square footage since 2009 in the small spaces included many video, books, and music shops, all sedentary type activities. Some big net gainers in that same time frame include specialty health and spas, yogurt shops, and weight reduction centers, just in case you were wondering. The recycling process both continues and will be continuous. This is not a one-shot initiative, and the asset decisions are driven by each regional president's assessment of their own portfolio strengths and weaknesses. A great example is in our southeastern Florida region. Over the past year, Paul Puma and his team have sold 10 properties, with 5 more slated for the first half of 2012, which combined represent about 1.2 million square feet and $8 million of net operating income. The total sales proceeds of $95 million have partially funded the $133 million of the region's purchase of new centers that will generate about $9.5 million in NOI. While the sale cap rates were around 9 and the purchase cap rates were about 7, we moved out of poor markets with either weak anchors or chronic vacancy into well-leased and well-positioned assets in our core markets. The U.S. same-site net operating income of 1.1% for this past quarter, as well as the third quarter, was nicked a bit by the effect of the Borders and A&P bankruptcies, which shaved about 60 basis points from the fourth quarter number. That said, the news on those spaces is good. We've now signed new leases with supermarket users for each of the 3 A&P lease rejections, totaling 150,000 square feet. Of the 16 Borders, we now have 4 leases executed, and we expect another 8 done by mid-2012. At this point, the composite releasing spreads are actually a slight positive. Contrast that with the 15 to 20% downsides on the Linen and Things and Circuit City boxes from 2 years ago. This reflects the quality of the real estate and the changing market for space. The interest level in these boxes underscore what we and other landlords have been saying for a while, that there is continued demand by retailers for space and a declining inventory to satisfy it. Within the Kimco portfolio, the number of anchor spaces, 10,000 square feet and greater as we define it, has been reduced to a little over 100 boxes, or just 2.7% of the total GLA, which essentially means that opportunities to capture stronger retailers and concepts will be more from rollover or recapture of maturing leases, and yes, even more bankruptcies. That may not result in big increases in reported occupancy, but more a continuous repositioning and value creation opportunities within the existing shopping center portfolio. We're seeing that in a couple of very recent examples. In Pompano, Florida, we negotiated a termination of an announced Kmart closing with limited term left, and are currently pursuing a redevelopment for a supermarket and hard goods retailer. Conversely, in San Diego, we took a long-standing dark and paying supermarket at a location with a 2012 lease end date and relet it to a fitness club alongside a sporting goods co-tenant at a much higher spread. And considering the ongoing action in anchor leasing and retention, the big push is in the smaller spaces, ranging from redoubling our efforts in the traditional approaches, pursuing alternative use, combining spaces where economically viable, and sometimes demolishing and refocusing available land for outparcels. 2012 will be very much a year of working the small details, the nickels and dimes of shopping center leasing and management. And beyond traditional approaches, we're also pursuing any and all angles to secure new users and enhance shopping center performance with a series of initiatives ranging from pre-approving locations with franchisors to market to potential users, mobile marketing technology and site-specific program to support mom and pops, and ancillary income from cell tower, solar, trash management, and other programs. And finally, in our Mexico portfolio, our team met their goals for leasing by signing 732,000 square feet of new deals and driving the composite occupancy rate to 84.4%. Our target is an additional 800,000 square feet for 2012. With that, I'll turn it over to Milton.
Well, thanks, Mike. We are in an environment of low interest rates. There is little inflation, and there are signs of improvement in the job market and other economic indicators. Much more is needed, but we are heading in the right direction. If the trend is confirmed and continues, all commercial real estate will benefit. Of course, we have no control over the economy, but what we do control and where our focus must lie is on our portfolio and our strategy And what does that mean for Kimco? 1, continue improving our key portfolio operating metrics. 2, continue our momentum of exiting our non-retail assets and our non-strategic shopping centers. 3, anticipate the ever-changing landscape in retail and seize opportunities as we have done on so many occasions in the past. Overall, we feel very good about the prospects of many of the retailers and their increasing need for space. Restaurants, health clubs, service businesses, such as dry cleaners, nails, all are relatively immune to the internet and are rapidly growing again. The positive news is that there has been essentially no new development in our sector, and specifically, there have been no new malls built within the past several years, and some of the existing mall tenants are seeking space in neighborhood and community shopping centers to meet their expansion needs. With relatively few new retail developments and continued population growth, there should be improvement in both occupancy and rents. I also believe that cap rates will compress. The spread between 10-year treasuries and cap rates is simply too high compared to historic spreads. My sense is that it is good to control close to 1 billion square feet of land in a growing country. We continue to seize opportunities with weak retailers with strong real estate, using our extensive experience and contacts in the bankruptcy arena. We recently took back 3 leases in both the Sims and AP bankruptcies that will allow us to either redevelop the centers or simply release at higher rents. We are continuing our program of rationalizing our portfolio by selling non-strategic assets. Now let's look back and note what we have achieved since the depth of the Great Recession. Since the S&P 500 index reached its lows in March 2009, Kimco's total return of 182% compares very favorably to the S&P 500 total return of 74% over the same time period. We also outperformed the NAREIT index. We've been through many cycles, and we now have more than 20 years' experience of being a public company and celebrated our anniversary last year. It was a special celebration for all of us at Kimco, and we're excited about our future and the prospects for our company. And with that, we will be delighted to answer any questions that you may have.
Cynthia, we're ready to move on to the question and answer portion of the call, please.
Very good, gentlemen. Today's question and answer session will be conducted electronically. If you would like to ask a question, you may do so by pressing the star key, followed by the digit 1 on your touch-tone telephone. If you are using a speakerphone, please make sure the mute function is turned off to allow the signal to reach our equipment. Once again, if you would like to ask a question, please press star 1. So that everyone may have the opportunity to ask a question today, please limit yourself to 1 question. If you have additional questions, you may place yourself back in the queue by pressing star 1 again. We will take our first question from Paul Morgan with Morgan Stanley. Please go ahead.
Hi, good morning. Milton, you just said you expect cap rates to compress further. Wondering if maybe you could add a little color there, and then just to the extent that you think that is upcoming, would that affect your acquisition and disposition appetite? If you expect cap rates to compress, would you kind of hold back a bit on dispositions and wait for that, or similarly kind of accelerate or change the target set for acquisitions?
Let me answer the latter part of your question first. It will not affect our desire and momentum to exit the non-strategic assets and the lesser quality assets. Our objective is to have the highest quality portfolio. And I do think that cap rates, as I've mentioned, at the spread, if you're buying a cap rate of 7%, let's say, or even 6%, it's still a spread of over 400 basis points at the lower end over treasuries. And when you consider the possibilities of inflation, the fact that there is a tax savings in having depreciation in real estate assets, that residual value should increase as the country grows. We will have 39 million more people in America at the end of 10 years. That's more than the population of Canada and Australia, so residual value should be higher. So that is my thesis, Paul, or my view that cap rates will compress.
And Paul, we're seeing it every month in terms of the high-quality centers we're bidding on. There's more and more bidders for those very high-quality centers, and cap rates continue to drift down.
We will take our next question from Quentin Valelli with Citi. Please go ahead.
Hey, good morning. I'm here with Michael Billerman as well. My question just focuses on the small shop occupancy, so maybe for Mike. In terms of the occupancy in the quarter sequentially, I think it was up about 70 basis points. Obviously, there's been some changes in terms of asset acquisitions and sales. So firstly, I'm not sure if you had a same property, what the occupancy increased by over the quarter. And then as you look to 2012 guidance, can you give us sort of an expectation of where you think small shop occupancy is going to move throughout the year?
Okay, Quentin, my first question back to you is, were you looking for same-site occupancy for the smaller spaces only?
Yeah, just for the smaller spaces.
Yeah. I've not broken that down at that level. What I can tell you is that the increase in the small store occupancy and even the anchor occupancy came about, I would suggest, half and half. Half from positive absorption and half from the disposition activities. As we sell some of these poorly occupied centers, this non-strategic part of our portfolio, we're gaining disproportionately, if you will, in the small store vacancies. So while I didn't give you the numbers, I think you could take from the comment that a lot of the improvement has come from addition by subtraction. Now, your question on 2012 with respect to targets and the underlying assumptions in small ticket leasing, Glenn had pointed out that the overall occupancy increase is going to be 50 to 100 basis points. That's a combination in our planning of both positive absorption as well as that ongoing disposition activity. Again, I think it'll probably be a half and half proposition, with the high end improvement of the occupancy reflecting more aggressive disposition activity. Hopefully that helps.
We will take our next question from Craig Schmidt with Bank of America Merrill Lynch. Please go ahead.
Hi. You had commented on the progress in Mexico. I was wondering, when do you think the leasing levels of Mexico will be sort of in line with the rest of your portfolio? And are there any challenges to getting there, and what's the concentration of vacancy, like small shops, whatever?
Our budget is to try to get to a 90% level for the entire basket, and you have to remember the entire basket has some recently completed properties, so that's why it's not there yet. Leasing is accelerating. We feel very good, as we said in the remarks. We're seeing increasing activity from Mexican retailers as well as the continued activity from the international retailers, and we're seeing a pickup in Mexico, just like the U.S. in the small shop leasing. The challenges to getting there, obviously, especially in an election year in Mexico, is possible turmoil in Mexico, but honestly, it really seems that they're just powering through the headlines that you may see, and it's helped by the fact that Mexico continues to be understored by any metric you want to look at compared to the U.S. And the underlying economy is strong with sustained GDP growth between 3% and 4%, low unemployment, The manufacturing base is coming back very strongly there. So we feel good. So test us if we get to the 90% level by year end, but that's our firm goal.
Yeah, and just one other thing to add to that, Craig, in terms of reaching that goal, and if you will, to your point about catching up to the rest of the portfolio, if things proceed as planned, it's really a 2013, 2014 type full stabilization point across the entire portfolio, where we hope that the U.S. occupancies, the Mexico occupancies will be, for lack of a better term, indistinguishable, as long as it's all to the good. But that's our time frame.
We will take our next question from Jay Haberman with Goldman Sachs. Please go ahead.
Good morning. Just a question on the hotel portfolio. It sounds like the interest has increased as you've broadened the marketing. Can you give us a sense of perhaps pricing as compared to where you were last summer, and maybe some expectation for timing?
Well, you hit the two things that really make us firmly believe that we will get this baby sold this year. One is that the whole market has picked up since the second half of last year when the CMBS market imploded and we were headed towards another downturn. We're seeing the exact opposite right now. There's an increasing level of interest in the hotel portfolio. And with our partners' new permission, we have broadened the marketing effort, and we do have a number of very interested parties. Our pricing remains exactly what we established before, which will get us out whole in terms of our book investment, and maybe a little more if we're lucky. Underneath it, as we mentioned, the properties are doing very well. The RevPAR is increasing substantially, and I think that's what's going on. As there's the hint of recovery out there, investors are looking at hotel assets which can be priced daily, or in our case weekly, as possible inflation hedge. In our case, even at our price, you're buying way below replacement cost, and it's an established brand and a platform and so forth. So we feel good about making something happen with this relatively soon.
I mean, from a modeling standpoint, in our guidance, we modeled in that it would get sold sometime during the third quarter.
We will take our next question from Christy McElroy with UBS. Please go ahead.
Hey, good morning, guys. Just to follow up on some of the prior questions, but just to be clear on 2012 guidance, I'm wondering if you could talk about, just for the U.S. portfolio, what is your same-store NOI growth and your occupancy upside expectation? And then if you could also provide a total dollar volume for non-core, non-strategic disposition assumption for 2012.
On the U.S. same-store NOI, I mean, Glenn gave you the range of 1.5 to 3.5, and our base case in the U.S. lands right in the middle of that range, and that's why we've ranged it out as such. So for us, the upside case in the U.S. is really accelerating the timing of getting some of the leases that were signed late in 11, as well as some of the planned leases signed in early 12, to get those commencing rent sooner than our plan. And that's the primary driver more than it is occupancy increases. The upside in occupancies was really just a level to anticipate if the economy continues to recover more strongly, that will have a disproportionate positive effect in some of our small store strategies. So a long way of saying, Christy, that the U.S. piece of the puzzle is very consistent with the combined piece of the puzzle. Glenn, you want to comment on the disposition expectations?
Yes. So in terms of non-retail dispositions, as we mentioned, there's $495 million of book value assets remaining. We expect and have modeled in to sell around $250 million during 2012, so it's going to bring the number almost in half. And then on the non-strategic retail assets, we've modeled in there about $250 million of sales as well. So you can do that in connection with our overall capital plan. That's why we just remain in this recycling program and no need for further equity at this point.
Thank you.
We'll take our next question from Alexander Goldfarb with Sandler O'Neill. Please go ahead.
Oh, yes. Hi, good morning. Just going to look at the buyers of your non-core, the stuff that you're selling. Curious how they're financing, if they're cash buyers, if they're using local banks, or if it's, just by simply assuming the existing mortgage and maybe they don't have to put that much equity into it. And as a follow-up to that, the banks, at least at the community bank level, seem to be, everyone loves apartments. Curious what their view is of shopping centers that, of the type that you're selling.
Alex, the predominant buyer of our shopping centers, the B, C quality, smallish centers in our non-core markets, are almost always local guys. Local guys who either have capital available, have a local banking relationship, maybe coming off a 1031 exchange of selling another property, but it is very, very local. Our strategy has been on a one-off basis because these assets are diverse. There's no common thread to them. It's not a single market, etc. So because of that, and we're oftentimes asked about how the CMBS market has affected our program or capital availability in general, it really hasn't. The thing that more impacts the velocity of our program is the fact that because this is the bottom rung of our portfolio, there is, in the normal course of business, more tenant fallout. There's more questions about viability of some of the smaller tenancies and the resiliency of whatever anchors are there. So there's a lot of horse trading that goes on. We try to accelerate the process as best we can, and we'll need to make concessions in certain cases, but we're committed to move. It isn't financing that's going to drive the bus, at least for this round of disposition.
Okay, and then as far as, rates staying low for, through potentially the end of 2014, are you seeing, Milton, you spoke about cap rates coming down, which, makes sense just given the environment, but are you seeing the lenders, coming down commensurately, or you see that gap between financing and cap rates widen?
Alex, it's Glenn. I mean, when you look at non-recourse mortgage financing, rates have definitely started to compress. Spreads have started to compress again. As you know, the market got pretty frozen again during the latter half of 2011. That has definitely thawed, and there's a lot of activity again, and you're starting to see spread compression, both on the non-recourse side, and you're seeing spread compression even in the unsecured bond market, even at the levels that treasuries are at today. So I think the capital markets are actually in very, very good shape, and it also goes to the bank market. Bank market spreads have also come in.
We'll take our next question from Jeffrey Donnelly with Wells Fargo. Please go ahead.
Good morning, guys. Actually, I just want to maybe follow up on Alex's question. Can you talk about the spreads that you're seeing between cap rates, between A and B and C centers, and maybe how that's changed in the last 3 to 6 months? I'm just curious if it's widening and tightening, and maybe what's driving, which segments are moving around most.
Yeah. Jeff, at least as we see it through the lens of our dispositions, again, with the peculiar nature of the properties, the sale exit cap rates have generally hovered in the 9s as an average. Some are less, some are more, depending on what type of asset we're really exiting. So it's remained, relatively speaking, at that level, notwithstanding some of the compression in financing spreads and so on. Again, because there's much more real estate risk associated with some of these assets. As to the higher quality properties, now the A's, the B pluses, just echoing what Dave had said, is as the continual flight to quality persists, we're seeing more and more compression of cap rates, so that, as Milton suggested, the cap rates are going down. You're clearly seeing it on the frontier of the A's and the B pluses.
What I'd add, cap rates and interest rates are tied at the hip. And I think Glenn has pointed out to us that financing is available, 10-year financing is available at the 4s. And if you have 10-year available at the 4s, you could readily determine that cap rates are going to be less than 7.
But it really is a tale of two cities out there. The high quality, very low cap rates, and the B properties in secondary markets or tertiary markets, the limited bidders and higher cap rates.
We will take our next question from Nathan Isby with Stifel Nicolaus. Please go ahead.
Hi, good morning. Can you just give us a little insight into how you're game planning for the remaining 48 Sears Kmart locations in your portfolio? Maybe how you would stratify the stores between easy to release and those that might languish for a while?
Well, we do have a business plan for each and every Kmart location, and primarily our exposure is Kmart, right, with a handful of Sears. But there is a game plan, and there are in different buckets. Milton, if you want to talk a little bit.
Well, again, the Sears are a very tiny portion. Insofar as Kmart is concerned, there are two aspects. One, their credit, and when we look at their credit, it's still a $4.4 billion equity market cap, and thus far they have not closed any of the stores in our market. Indeed, in Pompano, we paid to cancel the lease to Kmart, and we're replacing that with a very aggressive supermarket, a sporting goods. We can redevelop that and do very well. So you get back to the fundamentals of real estate, and where the real estate is good and the rents are good, we should be able to recycle those that are closed. There has only been one closed in our portfolio.
And if you remember, in 2002, when Kmart went bankrupt, the very high rent leases or the very poorest performing stores were rejected at that point. So the portfolio at that time that we were left with was a very high quality portfolio, either in terms of very low rents or very good locations. And we just want to assure everybody we are being very proactive about this, and to the extent we can take back some of these properties early, we will do so, and they should find good homes.
Another comment on the Sears Kmart credit. You must remember, one, that Sears owns a very large stake in Sears Canada. That is wonderful assets and doing relatively better. Two, they have an internet function that has been quite successful. So that may be the reason why there is that $4.4 billion market cap.
We'll take our next question from Rich Moore with RBC Capital Markets. Please go ahead.
Yeah, hello, good morning, guys. I saw a gain on the sale of development properties in the income statement, and it reminded me of the old KDI days. And I'm curious, I guess, two things. One, was that a KDI gain? And two, how do you guys think about KDI going forward? Is there a possibility we could see more life to the merchant development sort of concept?
We haven't had a merchant building gain in quite a while. This was a KDI asset. So it was a merchant building asset, and we had the opportunity to sell it. It's an asset that is in our taxable REIT subsidiary. And as we've always done, merchant building gains have been included in FFO, but only to the extent of the economic gain. So will you see a lot more of it? Probably not. There's not a whole lot of KDI assets that are left within the TRS. There's a few, and we'll keep an eye on them as we go. But again, the main focus, I think, for us is that we continue to focus on the recurring flows, and the gain, again, is part of the headline number, but not in the recurring numbers.
Two comments. One is we will probably, very unlikely that we would ever go back into the trading business, merchant building, where we build and sell. To the extent the economics make sense, we will build and hold. We are a believer in the long-term recurring income, especially if we're going to build a quality property. We're going to hold that. But just to clarify, Glenn, a lot of that gain in the numbers came from selling a KDI property into a new joint venture with SEB.